come to one question. Question number 70. Question number 70. Have you read this question? I said super expected. Let us try to understand. Beside construction activity, Building and Company Limited is also engaged in trading of copper. Means they are engaged in trading of copper. On 1st April 2001, it had 100 kg of copper costing rupees 70 per kg, totaling rupees 7,000. Start drawing what? Timeline. The company has a scheduled delivery of these 100 kg of copper to its customer on 30th September 2001. Means after how many months? 6 months. At a rate of US dollar 100 on that date. Means they have done one contract to sell this copper at in foreign currency, that is US dollar of 100. To protect itself from decline in currency exchange rate, the entity hedges its position by entering into currency future contract for equivalent currency unit at rupees 76 per US dollar. Means there was a sale contract which will be executed after 6 months in dollar. Means there will be some receivable in dollar, and if the dollar rate will depreciate, so there is a risk, then some less amount will be received. So to hedge that risk, they have entered into a future contract. Future contract, correct? So there is a risk of decline in foreign currency rate. So they enter into which contract? Buy contract or sell contract? The entity hedges its position by entering into currency future contract for equivalent currency unit at rupees 76 per US dollar. Means you can see they have not given whether they have enter into to buy dollar or to sell dollar. It means we need to understand by our own. It will be to buy dollar. Understood? Yes, sir. The future contract mature on 30th September 2001. You can see it will mature, and the scheduled delivery date was also 30th September 2001. 30th September 2001. Yes, sir. The management performed an assessment of hedge effectiveness and concluded that hedging relationship qualify for cash flow hedge. Thank you very much. It is given what? Cash flow hedge accounting. Yes, sir. The entity determine and document the changes in fair value of currency future contract will be highly effective in offsetting variability in cash flow of currency exchange. On 30th September 2001, entity closes out its currency future contract. Closes means they have settled it. The entity closes out its currency future contract means they have closed it. On the same day, it also sell its inventory of copper at US dollar 100 when the spot rate is 72 per US dollar. So they have also sold the inventory. Yes, sir. You are required to prepare detailed working and pass necessary journal entry for sale of copper and corresponding hedge instrument taken by the company. Pass the journal entry as on the initial date, first quarter and reporting 30th June, and the date of sale of copper and settlement of forward contract on 30th September 2001. Means they are saying that we prepare financial statement on quarterly basis. So each quarter end will be a reporting date. Each quarter end will be a reporting date. Assume the exchange rate as follow and the yield at 6% per annum. Whenever they give yield means we need to calculate present value. Means we need to find out the fair value of forward contract by discounting. By discounting. There is common sense, they have given yield rate means we'll find out fair value by discounting only. Correct? Yes, sir. Now they have given date, then they have given future price. But this is forward rate or spot rate? This is forward rate. Correct? The future price on 30th September 2001 delivery. So they have given what? Forward rate. Okay, sir. Okay, solution question done. Now let us come to the solution. You have drawn timeline. So question number 70 we are doing. What is the date of contract? Can you say me? 1/4/2001. How much? What is the cost price of inventory? It is how many inventory? 100 kg na. So 100 kg multiplied by 70, and they have scheduled delivery, means they have an expected sale, correct? Or I will say scheduled means there is a committed sale, correct now? So there is an, I will say, future sale, future sale contract, correct? Which will be on which date? 30th September 2001, to sell at what? To sell 100 kg at what? 100 USD. 100 USD, correct? Got it? Yes, sir. Now they have entered into a forward contract to sell or buy, to buy 100 US dollar at what? At 76, at 76. Yes, sir. Then first quarter end is what? 30th June 2001. Then it is 30th September 2001. Correct? So can you give me the forward rate? It is 76 here. Then how much it is given? 74. Then how much it is given? 71. Can you say spot rate? Spot rate is actually not required, and they have not given this spot rate. They have not given this spot rate, but they have given this spot rate 72. However, from my point of view, it is not correct. This should be same only. It cannot be different. It cannot be different, because this is the forward rate for how many months? 6 months. This forward rate for how many months? 3 months. And this cannot be forward rate. 71 cannot be forward rate because this settlement date. So this will be 0 month only. And from my point of view, as per whatever I have the knowledge of practical, whatever I am dealing, this should be same only. But I don't know why they have given different. But can you challenge the question in exam? Can you write down that you don't know anything? I know everything. This type of note cannot be written in exam. Correct now. You can't write down that question is wrong. Therefore, I am taking this. You can't write down. Whatever is given, you need to apply that. So if this question is coming, so we'll not change the question. We'll do whatever is given, whatever has been given. But can I say practically this should be same? Practically this should be same. I hope you're understanding my emotions. I think every point I have written is something is left. All information I have written. Then actual sale was done here. Actual sale was done here. Okay, sir. This was the entire story. It means, can you say we need to find out a fair value of forward contract? So this is nil. This is nil. Correct now. So we'll compare these two. We will compare these two. So this will become what? 7. It is what? First, but the favorable, unfavorable. But the favorable, unfavorable. What you are saying? Hmm? One minute. They are expecting what? Dollar rate will decrease, na? So why written sale? 1 minute. To protect itself from declining in currency exchange rate. So I have written to buy. The expectation is that it will decrease now. Oh, it will be to sell. Why have written? पता नहीं. चलो ठीक है. My mistake. The expectation was what? What is given? To protect itself from declining in currency exchange rate. Understood? So they will enter into sell now because they will receive what? They will receive what? Dollar. So they will enter into a contract to sell dollar because they are expecting that the price may fall. Understood? So it will be to sell contract, not to buy contract. Understood? Now batao, favorable, unfavorable. It is what? They are expecting it will decline and it has declined. So it is what? Favorable. This is also what? Favorable. My question to you all, what will be the fair value? It is 76 minus 74. How much 2? 2 into what? 100. That is how much? 200. And this will be what? 71 minus what? 76. Very good. So 76 minus 71. It is 5. 5 into 100. That is equal to 500. Understood. But now we need to multiply with the present value factor. Present value factor. Understood. Understood. Just try to understand. When I am saying fair value of forward contract, it means this is what? Fair value of forward contract which is expected at the end of this on 30th September 2001. Correct now? Understood what I am saying? So if it is nil, so this will be realized. This will be realized at the end of 6 months. This will be realized at the end of 3 months, and this will be realized right now only. It means if you want to find out the present value, so what will be the present value factor for the first nil? It will be discounted for 2 tenure, correct? At a rate of 6% per annum it is given. So how much per quarter? So can I say the discounting rate is 6% per annum. So it is 6 divided by 4, that is 1.6 divided by 4, it is 1.5% per quarter. So can you give me present value factor at a rate of 1.5% for 2 period I should write down. Yeah, 2 tenure, 2 terms, whatever you say. And this will be 1.5% for 1 tenure, and this will be what? 1.5% for 0 tenure. Understood? So this will be 1, means you should do 1.015 divide equal to, sorry, 1.015 divide equal to, why my answer is not coming? What is your coming? 0.985. Correct? This is how much? 0. My answer is not coming. Why? Oh, now come. Something is wrong in this calculator. Sure. What is this coming? 0.970. 970? 971. But I hope you have understood what I am saying. Have you understood this? Bro, have you understood this? Yes, sir. So can you now multiply 0 into this 0? 200 into 0.985 calculator bekar yaar. My calculator is not working. You need to only say 197 and this will be how much? 500. Got it? Just try to understand everyone. When we have done ESOP mein when I am comparing market price minus exercise price, it was intrinsic value. And when we have discounted it, it become fair value. So whenever you are saying fair value forward contract, can I say it should be discounted only if the time value of money is better here? If the settlement date is 3 months, etc., so it might happen the time value of money is not better here, so we can ignore discounting also. But from examination point of view, whenever they have given discount rate, it means you need to use discounting. Understood? Means when I have discussed in ESOP fair value of option. So what was the fair value of option? Fair value of option in ESOP chapter was what? It was the present value of expected intrinsic value on exercise date. You remember? Ind AS 102 you remember? Not remember. We have done before this only. Correct? Forgotten. Chalo, theek hai. This much you understood what we have done? Correct. Now we can do the accounting. Let us start. So for entering into on 1/4/2001, for entering into forward contract, no journal entry. Then on 30th June 2001, what journal entry? Derivative, financial asset, account debit, because it is cash flow, OCI, cash flow has reserve, how much? 197. Then on 30th September 2001, the value increases, so derivative financial asset, account debit to OCI, cash flow has reserve how much? 500 minus 197, that is 303. 303. Gain now will pass journal entry with the gain. Then can derivative can be settled separately? Yes sir. So what journal entry? Bank account debit to derivative financial asset, how much? 500, and we'll do one sale journal entry. Sale journal entry is what? Bank account or receivable account, that we don't know it is which sale, cash sales or credit sales, to what? Revenue. A revenue. So it was at which dollar? 100 into what spot rate is what? 72. So $100, huh? This is $100. $100 into 72, that is 7,200. 7,200. Now you only show what you will do about cash flow has reserve. Effective, it is effective, but it does not result in any non-financial asset. Therefore, it is other case. Therefore, it will be reclassified to PL. What journal entry you will do? So you have OCI credit balance. So OCI cash flow has reserve account debit to what? You can transfer to PL or adjust with revenue only. To revenue PL, how much? 500. Got it? Have you understood?